Hey there, and welcome. So if you've ever looked into Ijarah Sukuk, you've probably had that one big question pop into your head. Where do my returns actually come from? Well, over the next few minutes, we're going to trace the money, step by step, from the actual asset all the way into your bank account.
Okay, let's just jump right into the question that really matters, doesn't it? How do these investments actually make you money? It's probably a lot simpler and more direct than you might think.
So here's the fundamental difference, the most important thing to grasp. Your returns from a sukuk are not interest. Interest is a fee you pay for borrowing money. This is completely different. Your return is rent, a straightforward fee that someone pays to use a real, tangible asset. This is the absolute core principle that keeps everything Sharia compliant.
Right, so if it's rent, where is it coming from? And more importantly, how does it find its way to you? Let's follow the money and see how the cash actually flows.
The journey of the cash is incredibly straightforward, really. It's just 3 simple steps. First, you've got a tenant who pays rent to use the asset. Pretty simple. Second, that rent gets collected by a special entity. It's called an SPV. And finally, after any little expenses are taken out, the net rent gets distributed directly to you. That's it. It's a clean, direct line from the asset being used to cash in your pocket. Now, to really get comfortable with your investment, you just need to know a handful of key terms. Think of it like learning the basic language of your cash flow. Let's break them down real quick.
First up, we've got the principal, which is also called the face value. This is easy. It's just the total amount of money you put in to buy your piece of the sukuk. This is our starting point for everything else.
Next is the annual rental rate. This is the all-important percentage. We use this number to figure out the total rental income the asset is supposed to generate over 1 full year, and it's all based on that principal amount.
And all of that leads us right here, to the distribution. This is the good part. It's the actual cash payment you receive in your account. It's your slice of the rental income paid out at regular intervals, maybe every quarter or every 6 months. And last but not least, there's maturity. This is simply the end date, the finish line for the sukuk. It marks the end of the whole rental period, and it's when you're scheduled to get your initial principal investment back.
Okay, so we've got the terms down. Now let's put them to work. Turns out you only need one super simple equation to figure out your return. This really puts the power of understanding right in your own hands.
And here it is, see? No complex algebra. Your distribution is just your principal times that annual rental rate, and then you adjust it for whatever the payment period is. So if you get paid quarterly, that's just 3 months out of 12. If it's semi-annually, it's 6 out of 12. It really is that simple.
Let's make this real with an example. Let's say the principal is a nice round $10 million. The annual rate is 6%, and you get your distributions every 6 months. So you just take that $10 million, multiply it by 6%, and then adjust it for that 6-month period.
And what do you get? Boom, a semi-annual distribution of $300,000. See, there are no black boxes here, no secret formulas. It's just clear, simple math.
So what happens when you take these individual payments and map them out over the whole life of the investment? Well, you get a really clear, predictable distribution schedule. Let's actually visualize what your returns look like.
And here's what that looks like in practice. Let's say you have a 1-year sukuk with a $5 million principal and a 12% annual rate, paid quarterly. What's the result? A consistent, totally predictable payment of $150,000 every single quarter. You know exactly what to expect and exactly when it's coming.
So what happens after that last quarterly payment comes in? Well, at maturity, the underlying asset is sold, and your full principal, the money you started with, is returned to you. That whole series of rental payments you received, that was your profit. Your initial stake comes right back home at the end.
Now that schedule we just looked at was for a fixed rate, but that's not the only way these can work. Let's take a quick look at the 2 main flavors of rental rates you're likely to see.
On one hand, you have a fixed rate. That's exactly what we just saw. It's predictable, it's stable, and it's super easy to understand. On the other hand, you might see a variable rate. This type is tied to some financial benchmark, so it can actually change over time. This, of course, gives it a different kind of risk and return profile.
But here's the key. Even with a variable rate, there are absolutely no secrets. The rules have to be laid out with complete transparency from day one. You have to be told the exact reference index they're using, the precise formula for calculating the rent, like say, the index plus a certain margin, and the specific dates when the rate will be reset. It's all about clarity.
And you know, all of this
It brings us back to the foundation of this entire structure: transparency and trust. These calculations, these schedules, they're not just numbers on a page. They're a promise.
And that promise is backed up by regular, detailed reports. You'll get updates on how the rent collection is going, the physical condition of the asset, its insurance coverage, and a clear breakdown of any expenses. This is all to make sure the investment is performing exactly the way it's supposed to.
And what's really exciting is how modern technology is just making all of this even more solid. Fintech platforms are now using amazing tools like blockchain and integrated ERP systems to make every single transaction transparent, auditable, and secure. At the end of the day, this isn't just about finance. It's about building a system where you can see and verify every single step of your investment's journey. Now that is what we call a clear path to returns.